Perfect. First of all, thanks for having us today. We had some lively discussion pre-conference around this topic. Goals-based investing is, I would say, one of the largest trends that we see emerging within the wealth space. There's been an enormous growth of what I call goals-based planning and financial planning. And the question then is, how do you connect the planning work that you do with clients to the investment work that you do? I oftentimes find visuals more helpful, so I'll put a few up there. If we're going to define it in a simple terminology, is how do we turn the financial plan into what I would say is a truly personalized portfolio allocation? It sounds very simple, it sounds quite easy. It's not, it's extremely difficult. And one of the largest and biggest challenges that we see across large enterprise wealth firms is, in essence, connecting those two things together, the plan and the portfolio. They are fundamentally disconnected today, right? And that's a fairly bold statement. But when we look at the framework that exists today, it tends to look something like this. We sit down, we do extensive financial planning, 8, 10, 12 hours worth of work. We learn about clients' hopes, dreams, desires, aspirations. And then we put all of that aside and we bring out a risk tolerance questionnaire. And we say, how much can you lose before you lose sleep at night? And no one knows how to answer that question. You get a different response in a bull market versus a bear market. And when, like right now, I can lose, whatever, it's all good, but in the depths of the financial crisis, they answer very differently. The output of the risk tolerance questionnaire generates a score, and that score simply gets mapped to a sort of pre-built model. So it's kind of risk score to model 3 on the shelf. And because most clients answer the risk tolerance questionnaire the same way, most clients end up in the same portfolio. And I can't tell you how many firms say to us, most of our clients are in the moderate portfolio. I don't think that's surprising. What's surprising to me is they admit it, that that's the case. And what you see here is an example of it. We call it the two client problem, and that is 2 clients, different ages, different retirement dates, different income levels, different savings rates, different assets. But if they answer the risk tolerance questionnaire the same way, they end up in the same portfolio. And that doesn't make sense because we all have different goals. And so to answer your question, the way we deliver goals-based investing is simply to connect the financial plan to a personalized portfolio. And I think we'll get into how we do that, and we have a framework that we'll introduce throughout the discussion today, but that's how I sort of open up the stage for today.
That's great, Adam. Michael, I have a question for you, and then for you, Rose. Michael, so you've done a lot of work around the psychology of investors, and we talked a little bit about recency bias, and there's other biases. There's even ambiguity bias or ambivalence bias I read about. Can you talk about sort of what are these biases? I guess there's emotional biases, there's cognitive biases, and like, it sounds to me like the upshot is clients panic, right? How do you prevent that? Yeah.
Well, so when we think of clients and their behaviors, and by the way, I love what you just laid out here. It's just true. and I love when we just look at truth, and yet we're still doing the same thing as an industry. So when you think of biases, I think it's important to flip the frame a bit and think about why human beings have certain tendencies. So we might call them biases, but we have to really examine why people are, and I just want to highlight one of the key, Nobel Prize winning biases is loss aversion. Raise your hand if you love losing money. Yeah. So one person, and so we think to ourselves, okay, that won a Nobel Prize that people don't like losing money. But did we really need a Nobel laureate to tell us that as an industry? And so you're highlighting this very idea, which is we call them biases, but we're decontextualizing it. People don't like losing money because money is a scarce resource. It has value, you've worked hard for it, someone else worked hard for it, right? It's stored value at the end of the day. And so losing that stored value is a potentially scary thing, especially if you're in retirement, you're not working, you have no other access to capital. And so we need to think about why we're calling even these behaviors biases, because in my mind, that's not a bias. That seems pretty intelligent to be loss averse, just like risk aversion. Putting your money at risk, it is considered to be a bias as well. Well, who just loves taking risk unnecessarily? Very few people, and it seems like a pretty intelligent thing to be skeptical of taking risk, because at the end of the day, there should be benefit on the other side of that risk. So I think a key part of all of these biases is really thinking about the information that we're delivering to human beings in the context of their lives. So one thing that I want to highlight is what can eradicate most of these biases in the mind. So I'm a cognitive scientist and basically a mathematician who's modeled the brain. And that's my life's work. And one thing that eradicates bias overall is when people have equivalent information. So there's no information asymmetry. So I think we need to think about as an industry, how are we presenting information, delivering information to human beings so they can make the best decisions that are right for them based on the context of their lives and their money, which is effectively what you've highlighted here.
You did it more eloquently than I did.
Well, I think, but it's important, and I think there's, in the United States in particular, there are biases in how that information is delivered. So who tends to think they have full information and knows everything about investing? Raise your hand if you think it's men. Do men think they know everything about investing? What do you think?
Probably.
Okay, so there's some truth to it. Actually, men tend to be highly overconfident in their knowledge, meaning they tend to think they know more than they actually do, technically speaking. And women tend towards something called underconfidence. They tend to think they know less than they actually do. And when you do the real testing, men and women are actually quite similar in their investment acumen and knowledge. So we need to think about, why is that unique to the United States? What are we doing as an industry to combat that so that people can make the right investment decisions on their behalf? So I just wanted to reframe the bias question and say we need to really think about how the mind works, why it works in the way it does, and in fact, these biases actually serve us, and we need to think about how we give people the right information to actually make the right decisions to get them where they want to go.
Sure, as you were talking, like I was thinking back to one of my college courses in psychology. That was a long time ago, but still, it was something to the effect that human beings tend to act, or tend to want to act when under stress, right? And that's probably a very primal self-preservation.
That makes sense.
But in a stock market meltdown, acting may or may not make sense. So, something to consider.
Correct, and that's where we come in, providing that information, that context. When does it make sense? When does it not make sense? And this is why we see the propagation of human advice in this era of, over-digitizing things. Rose and I were just talking about this, and we need to also be cautious of over-AIing things,
Right.
because the human being, we know factually, and the proximity of that human being to those making decisions can actually moderate a lot of those, let's call it reactive decisions that you're alluding to.
So I want to pivot to Rose here, because you're now at Edward Jones, of course, but you were previously with Money Guide Pro, InvestNet, and I mean, what Michael and Adam says is very illuminating, but like from a practical standpoint, we live in this sort of account-centric world. You've got, financial planning software that, as you said, may not connect very well to the portfolio. Like, what are the kind of tools you've seen be most effective in supporting clients and helping them steer the course?
Yeah, so it's a great question. I think it's so well connected with what Michael and Adam just said. The planning tools, it's a great way to start with clients on educating them and reframing conversations, really getting to what's most important to them. But historically, we have, as an industry, delivered a plan and then gone off as business as usual on the investing side and gone to that risk tolerance questionnaire, which not only does it take into account your goals, but also essentially says to a client, let me figure out how much risk you can tolerate, and let's take on as much risk as you can tolerate, right? Like essentially moving people toward sort of everybody in the same portfolio. I think one thing is that process that I just talked about getting to understand the client, about educating them, setting expectations is important. The integration that you see though between planning and portfolio construction and execution is sort of that next step that Adam said is so difficult. And it is difficult because we're in an account-based, sort of like we grew up with legacy platforms and data that are all account-based, and an environment where we have to understand that accounts and products aren't necessarily how clients show up to be invested. They come to the table with a pool of assets, and whether or not those are advisory or brokerage or internal or external, they need advice that's comprehensive. And our platforms aren't necessarily, or those are questions that we have to ask as firms, as advisors, when you start to engage clients. So I'll give you just some example from my previous experience. I was at Morgan Stanley a long time. We integrated our planning tools with our execution and our performance reporting at the beginning of the pandemic when trading was halted. We were at a point where we were systematically updating plans for advisors. When they came in on Monday morning, they had emails generated for each one of their clients. It's something to the effect of, last week was rough, I ran your plan on Friday night, and you're still okay. And I bring that, it was years ago, I bring that up now because it was really impactful to those clients. Those advisors forwarded me emails saying, my client sent me a thank you. At that time, when there was that much angst and anxiety, the information, Michael, to your point, that we're giving information to clients at the right time, that proximity to the event, can have such an enormous impact, not just on how they behave, but honestly on their mental health and well-being about how they address those things.
Yeah, that's great. I think when you talk about account-centric, I mean, now we're trying to move to, some of the firms we work with are very big on this unified managed household account, right? So you're not talking just accounts, you're talking individuals, you're talking perhaps extended families, and how to help, these parties get a sense for where they are and be comfortable where they're investing and build to the future.
I'll say, just on that point, one of the first things that I asked in my prior role at Investnet, working with firms, and when I joined Edward Jones, the very first question that I asked when we were embarking on this was, do you have your groupings right? And what you just said is really important. It feels very basic, but this idea of what accounts go together, how do I give access to that data in the right ways for either planning versus visibility online? So when we think about that transition from account-based to more holistic advice, thinking through data, thinking through those visualizations is something that everybody's facing.
Hey Rose, is it okay if we play a quick game with everyone to show them why this matters so much? So imagine you have a bunch of accounts, and if you were just looking at an account-centric idea around risk, I want you to play a game. All right, so let's imagine that you basically have $20. So you have two choices. You could have that $20 for sure, or you could expose it to risk for the possibility of either getting $100 or nothing on the other side of it. All right, so those are your choices: $20 for sure, or 100 or nothing with a 50% chance, let's say, equal probability. Raise your hand if you stick with the $20 or if you go for the risk. Raise your hand if you stick with the $20. Right, raise your hand if you go for the risk. Okay, great. So let's say that was one account. Now let's say you have 100 accounts that you put in a grouping. And so now we're gonna change it a bit, the dynamics. So now you have $2 million, okay, right Rose? $2 million toward a particular goal. Or you could put it at risk, either $10 million or $0. Again, equal probability. Raise your hand if you stick with the 2 million or you expose it for the equal probability of 10 million or 0. Do you stick with the 2 million or do you go for the risk? Raise your hand if you stick with the $2 million. Okay, so suddenly you've now changed your entire risk profile. I want to see who would go for the equal probability of 0 or 10. Okay, so very few people But that's Rose, your point, is those account groupings really matter. It fundamentally could change your risk profile because now you've contextualized the risk, but also contextualized the purpose of the money. $2 million suddenly feels much more important than $20, right, Rose?
For the account,
Yeah.
absolutely. And we're still in an environment where we are asking clients to answer that risk tolerance questionnaire per account. So challenge everybody to think about reimagining that experience for clients. I know I sat in a room with FINRA and we said clients cannot do that, right? Like their wealth has a purpose and we need to think through that in that way. So that's absolutely.
I'm gonna jump in and say this, it's not that risk tolerance should not be part of the equation though. So it's easy to sort of knock on it, it's an easy boogeyman, if you will. It's gotta be part of the equation. The way we think about solving for all of this, and we discussed this in sort of the pre-call, is really it comes down to is how do you personalize the client goals and the aspirations that you capture through that planning process and make the investment piece feel very connected between the two. Because, we heard it in the earlier session, which is we're trying to grow our practices, we're trying to grow our businesses. How do we differentiate the value that we deliver? And in a world where everything is becoming personalized to us, clients are looking for that in our industry. And so I'm gonna lay a kind of framework out here for you. It's a way to think about doing this. The first step is obviously starting with the goals, right? The more you talk about client goals, the more you talk about what this means to your portfolio, the more sticky they are, especially through market volatility. We see it in all of the data. So you see a lot of the financial planning tools, they do a phenomenal job. They do a great job gathering goals and cash flows and time horizons and things like that. But I would argue that the planning tools actually don't connect directly to the portfolio. They put it all aside, risk tolerance questionnaire comes up, the portfolio gets predetermined, and then they just run Monte Carlos to see what's the probability of you having money at the end of the plan. The solution, at least the way that we think about this, actually goes like this. We take the client goals, and we translate them into what we call a personalized wealth benchmark. What that black line on that screen you see at the bottom there represents is how much money, how much wealth are you going to need tomorrow, 5 years from now, 10 years from now, 20 years from now, in order to fund the goals that you have. And that wealth, that money, is at the household level. This gets back to what you were saying. And so once we have that framework of a wealth benchmark, which again is personalized to every client based on their goals and their plan, then we can construct a portfolio that maximizes the likelihood that your wealth stays above that target. This is extremely intuitive for clients, by the way. Now you see the green line in there. What we've plotted here is just sort of the projected wealth, but you notice in those early dots, you can have a dot that goes down. Markets are volatile, portfolio accounts are gonna go down. But imagine the client conversation with the advisor now. We're no longer talking about how am I doing relative to the S&P, how am I doing relative to some static stock bond mix, how are we doing relative to the amount of wealth that I need? So in an environment where the green dot goes down, you're on track, you actually have surplus wealth. This fundamentally changes the client conversation right here. And then once we do that, the reality is advisors still want some degree of autonomy, right? They still want to put their investment philosophy, I call it an identity, into the equation. And so the way that we think about this at Nevo is take the goals, translate it into a personal wealth benchmark, and then create what we call freedom within a framework. Give the advisor some freedom to choose what asset classes, what models they may want to use. I think about it like this: the CIO of the firm will stock the pantry with a certain set of ingredients. Those ingredients are certain models, certain asset class building blocks. The advisor can then choose what, quote, ingredients they want to use for that particular client. So the advisor chooses, and then what we do is we have this extremely powerful and intelligent portfolio optimization engine that sits under the hood. And what it does is it takes all of those models, all of those ingredients, all of those asset classes that the advisor chooses within the CIO context framework, and brings it together and creates a personalized portfolio for that client. And that portfolio that gets built off this optimization engine is the portfolio that has the highest probability that that client's wealth stays above the level they need to support their goals. What I just described sounds easy, sort of step 1, step 2, step 3, we were chatting. This is extremely difficult. But I would argue that the way that this industry solves the scalability paradox, how do I deliver more personalized advice to more clients, gets solved through 2 things. A more powerful portfolio optimization engine under the hood, and a freedom within a framework structure of investment ingredients that advisors can use to build truly tailored solutions for every single client. And I think there's an enormous opportunity here for firms to take this and think about how do we integrate it. And the most interesting and unique part of it for me is you don't have to change any of your existing infrastructure. And that's a huge piece of the equation. No one's coming in saying to change the infrastructure. Your models, your building blocks, your existing planning framework, we just insert this goals-driven engine under the hood to connect the plan and the portfolio together to scale advice in a very personalized way.
I just want to stress how incredibly impactful a personalized wealth benchmark can be. Having experience sort of implementing something similar, we didn't have the benefit of Nico being there, we built something in-house. I will tell you that is what changed that conversation. If you think about a client with market volatility logging into your online experience and having to rationalize what does that loss mean to me, instead putting this side by side to say, this is actually what this means to you, instead of having to have them interpret it themselves. And fundamentally, we would tell advisors, if we are going to talk about performance and how we did for you, we should talk about how you're doing against your goals, that, right, like your money has a purpose, and that should be part of the conversation. So really transforming that conversation from, I'm just looking at market balance, I'm just looking at my performance against the benchmark, which is arbitrary and doesn't mean anything to me. This really can have a lot of impact to client conversations.
So when you say goals, Rose, are you talking about sort of a personal benchmark, or you're talking about something tangible like buying a vacation home, or what does it look like in practice?
Yeah, I think it could be either, right? We could have here just sort of all of your wealth with some objective, and we're really telling you how are you doing against that, or you could have a very specific objective, like I'm trying to get to the vacation home. And you need to think about those experiences and have those conversations separately, because like the way that we were talking about how much risk do you want to take on, depending on how much money is in the portfolio, what that objective is, you may want to address that in a different way as well.
Interesting.
You know, specifically though, to answer your question is,
Mm-hmm.
every single goal, the time horizon for every single goal, the cash flows you need for every single goal, how much you want to spend in retirement, how much you're saving pre-retirement. In our framework, all of that we capture and we put in that black line, that wealth benchmark. So that wealth benchmark represents a household level, all of your goals. And then we simply translate it and say, how much money are you going to need today, tomorrow, 10 years from now? And once you have that wealth number, and you're constructing a portfolio to help people keep their wealth above that number, it's so intuitive for clients. They see the direct connection, and in all of the data, what we find is that clients that see that direct connection, I'd love to get your view on this, is they increase their wallet share to the advisor, they refer more clients over, and the close rate of advisors that present in this framework close prospects at 2x the rate that they do normally. So the challenge is I think in part shifting the conversation away from traditional stock market benchmarks to goals, and this wealth benchmark is a way to do it, to unlock.
Well, I think what you're doing in this framework, and I just want to add one more thing to, time horizon, dollar amount, priority does matter.
Priority absolutely.
Right, so the importance of the money, which is what you're alluding to. So if it's to buy a house, is it a primary residence, or is it a second home, or a third home, or a fourth home? That's going to make a difference. And ultimately, do you need that roof over your head, or is it optional? So there's just a lot going on within that framework too. But I would say what you're effectively doing is shifting the conversation from how much risk am I comfortable with to the risk I need to take versus my ability to take that risk. So it's that tension that you're really helping people navigate, because I might be able to take that risk, but I don't need to, or I need to take that risk even though I'm not able to. Well, then something needs to change about the pool of things I'm trying to accomplish with my money, or the targets I have in my head for how I want to achieve those things. And that's the great conversation to have with an advice provider, a planner, an advisor, whatever we want to call the human being. It's a much better conversation than frankly, the conversation you don't need to have and you could just get from a robo investment provider.
Well,
which is answering a 10-question questionnaire.
You're talking about a goals-based framework, which is what we're all talking about here. What actually happens though, as you move into the high net worth and ultra high net worth, is they're actually no longer goals-based clients. Generally speaking, they're good, right? So we can do this with a high net worth client, and they're gonna have almost 100% probability of achieving their goals. They're on track, they're on target, and so what happens there is the conversation becomes possibilities based, right? And this is where it gets super interesting, where you say, you're good, now let's explore some possibilities. So the amount of risk they quote need to take to achieve them is here, and then we move into, well, what's feasible for you? And now we can play a range of options between what you need to take and what you can feasibly receive from markets. And we can open up the aperture for things like, how much do we want to think about legacy now? Right?
Well, but this is really important. Think of lottery winners. Does it go well for them? Yes or no? No. And so the fundamental issue with lottery winners is suddenly everything becomes possible, and so you end up overdoing it. Risk, spending, you name it. And so what you're describing is you can kind of ring fence the needs then for a wealthy human being and say, and now here's the available funds to explore what's possible. And it's extremely powerful in that context too, because when I look at this, it starts opening the door to maybe too many things are possible, and you can kind of pull the client back a bit and say, well, actually you still need to maintain a certain risk aperture for the things that you want to be certain about, and then maybe you can increase that aperture for things that exploring in the sort of possible realm.
So this is super inspiring. It's also a fairly radical shift in our thinking in the industry. How can individual firms and advisors get started, right? It's like do we need tools? I know like Orion has launched a lot of tools that RIAs and some banks use. Obviously there's Nebo, but there seems to be both an implementation part, a transition phase, and also kind of an educational process.
So can I jump in here?
Yeah.
I think the first thing, if you in your own personal life are interested in these ideas, or to apply it as a professional at your firm, you need a framework first, or a philosophy, whether it's an investment philosophy, a planning philosophy. And I would say, in general, the human mind tends to frame things in terms of mental accounts or buckets. And I know we like to talk about goals a lot, goals-based investing, but human beings and goals generally don't go together. And I'm being really intentional by saying that. That's a more of a forced construct for human beings to keep track of. And so I'd encourage you to just really push yourself on that. Health goals, wellness goals, financial goals, you tend to lose your way pretty quickly after January 1st when you've committed to them, if that makes sense. So I would encourage you to think of buckets. And 4 buckets that tend to work is think of it as, I don't ever want to go below a certain amount of money in my life bucket. And if that's how you really feel, really think about what that is. Is it $20? Is it the $2 million? What is that amount of money? And you really have to think of, cash or cash-like strategies for that bucket. Then you have a second bucket, which is your spending bucket. And I can see everyone here is going to live for a very long time, possibly to over 100 years old. And this is why the whole glide path into retirement, we need to really revisit that too, because when people retire, they tend to live another 30, 40, possibly even 50 years. And so that traditional glide path doesn't really work anymore. So you really have to look at that bucket of spending. To your point on cash flow, how much is my cash flow need for how long do I predict I'll need it for? And you really need to construct, to your point, a unique personalized allocation to manage to that. And then the third bucket is this idea of preservation. So a lot of people do have this concept of giving something to someone or a cause, to carry on a purpose or an idea forward beyond their life or within their life. And so you want to preserve something. What does that mean to you? And the last one, which really kind of takes over for a lot of human beings in up markets, is this idea of growth. Human beings just love making money. Raise your hand if you hate making money. Okay, so you love making money, and that's really what gets into the way here. And so that fourth bucket, I would really encourage everyone, as you're thinking of these types of frameworks, put that last. That's where we focus as an industry, and I'm telling you, it's a mistake. That works when you have the magnitude of millions of people, tens of millions of people. That's like the economist's view. People become econs, no emotions. But when you have an N of one, it's that one human being taking care of a family, exposing them to extraordinary concentrated risk to get that capital growth. We have to ask ourselves, how responsible is that? At Edelman Financial Engines, we're fiduciaries. We really guide our clients on that topic. That bucket is really specific, has a specific purpose. And concentration leads to extraordinary outcomes like that 10 million or zero, but it can lead to the zero. So we have to be really responsible on bucket 4. So I just wanted to outline that. I would start with the framework and philosophy before applying tools.
Rose, you have extensive experience doing this. When we talked about it, it's hard, right? What's your advice?
I'll say this. We talked about a lot of things today. We talked about experience. We talked about ideas on new ways to construct portfolios and give advice. We talked about changing the risk conversation from what we traditionally do. So there is a lot to tackle. So and then we didn't even touch on execution. We haven't got to how do you execute that strategy across accounts that are internal, external, and have a bunch of rules associated with them. It definitely gets complex. My advice is take it in pieces. And we talked about how the framework can help. I'll add just one thing to it. Think about your client experience. Think about what you're taking a client through and how you're describing things to them when you reach out to them. I'll share with you just something from my past. We were so excited about updating plans on a weekly basis and giving advisors a dashboard that told them who's off track and who's on track. And what we realized was that advisors were really nervous about the fact that not only would they have to explain a downturn in the market, they'd have to explain why their plans were failing. And so we started tracking the number of clients that were on track at the firm versus what happened in the market, and we had to teach advisors that actually there's not a direct correlation between those things, and you can get clients to focus on the horizon. So education, so client experience and education are two other things that I think are primary focuses.
And there are tools out there to help with that.
Absolutely. Yeah.
Can I add to that? So I'm gonna kind of step back for a second. So we're coming at the conversation today through the lens of, we have a portfolio optimization engine that helps connect all these things together. I would tell you though that when we talk to firms, most of the initial conversations is exactly that. I do it this way today. It sort of works. It's efficient. We know we can improve upon it. How do we do it? How do we take the steps? And I have on the screen here sort of 5 big challenges that we see coming up time and time again. The first was the cornerstone of the discussion today, this disconnect from plan and portfolio. It's what I call hidden in plain sight. Everyone knows it, they're looking for solutions, this is really hard to do. What that manifests itself is you see very inconsistent advice across advisors as firms grow. So I can walk in to an advisor in Boston, and then I can walk into an advisor from the same firm in Los Angeles, and I could get 2 very, very different portfolios. All right, so you get inconsistent advice, so this framework becomes really important. We see
And the client experience elements.
the client experience, and you know where this really manifests too? As firms grow, if you're a client, you become a client of the firm, the advisor leaves, the new advisor takes over, they do it differently, and the client goes, well, wait a minute, like this is totally different than what I was seeing before. We see underutilization of firm investment CIO type expertise because they don't have the freedom, the advisor can't mix and match different asset classes. So this all sort of comes together. One of the big ones is the sort of resource misallocation. There's a huge amount of, I would say.
That's my favorite one, by the way.
Well, so here's what happens, right? The sort of mass affluent client gets a lot of attention in part because it's comfortable for the advisor, and they don't spend the time with a high net worth and ultra high net worth. So the ability to scale advice, in particular for the mass affluent client, frees up time in order to go up market, right? And so we see this all the time. And the last one we just put in here, which is the private market piece. Listen, private markets and private assets are coming in like we can't imagine, right? And there's no consistent framework right now.
Even 401ks.
We'll put that aside for a second. How do you know what the right amount of private assets are for the client? And you know, if something happens and you're in front of an arbiter and you say 10% felt right, that's not a good answer. And so part of the optimization process is to say, this is a client with very unique goals and aspirations, and we translate it, yes, through the wealth benchmark, we run the optimization, but just to say, what is the right mix of public and private markets together for this particular client, uniquely and precisely tailored to their unique circumstances. So these 5 interconnected challenges, I think, get solved by making the shift to a more goal-centric approach, this freedom within a framework sort of outline, and you need the tools, and it is not easy. Like what we are talking about is extremely difficult, but firms are very receptive.
Well, so, but this last one that you're highlighting really makes the point, which is there's the goals element, there's the asset allocation, the risk allocation, but preference plays a huge role in this, which Rose gets to your client experience example, and to your point on the consistency and application of said advice. You know, how are you keeping track of why? Why did you implement, for example, X percent?
Why do you have 12.2 in private credit?
Yeah, totally. And really getting to the heart of it, which a lot of times is in client preference. And a lot of people don't know younger clients are more into privates than older clients. You know, and you can start seeing then these patterns, to your point, apply at scale, and perhaps, you know, either normalize that or just lean into it and say, why is that happening? And that might be okay. And Rose, that gets to your point, you know, how does that then manifest itself in a consistent client experience?
In the experience, yeah,
Exactly.
because making that decision and then coming back and reminding clients when you have that performance review, when you're looking at the portfolio,
Here's why.
remember this is why.
Totally.
And that really creates some much better decision making.
So we've got a couple minutes left, maybe, and I've seen some interest in people sort of tentatively raising their hand. Time for a couple audience questions? Yes, sir. Mr. Blogger, yes. You project, just stand up.
I'll just yell.
Yeah.
Here comes the mic.
I'm meeting my colleague Rose Plaza. Great job today. Thank you so much. No, I love this conversation about goals versus buckets versus whatever. If you guys can delve into that, because to me, your example of the $20 versus $2 million is like that account kind of situation. Like, I'm assuming Adam, your whole thesis is away and in-house, you're putting it all in there when you're doing your thing. How do you manage that when you're talking to them to optimize how much they want to actually put at risk?
Yeah, the way we specifically do it is you list your goals and you can turn goals on and turn goals off in real time. And what happens is as you turn goals on and turn goals off, the shape and slope of your wealth benchmark will change. So I'll give you a really simple example. Let me go back. It's maybe hard to see on the chart here, but you see the black line there. If somebody says, I love my kids, and you say, great, well, how much do you love your, I have 4 kids, right? How much do you love your kids? Is like $250,000 worth of love at the end of the time? Is it more?
That's called control.
You know, I was like, well, you know, they didn't bring me coffee on Saturday morning, I don't love them as much today.
Exactly.
But, so what will happen is, you want to put legacy into your plan. Now it's a goal in your plan. You will see that black line at the end and something higher. Legacy is part of the goal. Now the question is that feasible given what assets you have today, what your spending rate is, what required returns are, and things of that nature? So the priority of the goals becomes really important, and we simply turn it off and turn it off. That right there, I will tell you, the ability to take, I listened to you, these are the things you told me are important, and be able to show in real time, turning on and turning off what's feasible, what's not feasible, that's the art of advice. And I think that's where AI is not going to necessarily be helpful. AI can do lots of math. We're not AI based, we're actually we're hardcore math. But that's the art of advice. And so the ability to toggle and go through different scenarios, and by the way, it's not a one-time thing, right? It's an ongoing process. And so when you can come back to the wealth benchmark, and you can come back to the goals on a regular review, and it's like, I now have to care for aging parents, and we bring that into the plan. Or the market has had a 20% decline, how does that impact? We use the term at NEBO, re-optimization. We're just going to re-optimize your plan. That could mean a change in the wealth benchmark. It could mean a change in your portfolio. So it's actually spot on the right question to be asking.
Time for one more question.
I have a question here. My name is Sri from Bank of America. We talked a lot about risk. I heard a lot about risk, but what I did not hear is spending. The hardest thing is changing spending behavior. And you may find that actually a customer is spending a lot of money, not saving enough, and therefore he needs to take more risk and go in a different trajectory. Versus actually, if the spending was controlled, he or she may be saving more, and therefore will be able to take a moderate risk. So unless we tackle this from a spending, which is a very stubborn problem to solve in terms of behavior, just from a risk point of view, I feel like this cannot be just solved.
And this is where what's more essential, right, the prioritization comes in versus more discretionary, and that's why I want to add that component in there. That's where it becomes critical to have that conversation. So if you think of the buckets I outlined, and this is where frameworks kind of overlay on top of, a tool or a capability. So if you have this sort of cash flow need that is more immediate, you don't want something to go below a certain amount, so think of that as your emergency fund or your operating cash. And then you have a spending bucket. You really need to look at that spending bucket and ask yourself, or that consumption bucket, is that sustainable? So I completely agree with you. And when you think of sustainability, what is a must-have versus what are all those things that are more optional? And I think we don't have those tough conversations as much as we should with clients. So I agree, we need to press into that. And it's most important to press into for young people because they have time on their side. For older people, it's more difficult.
One thing, there is a really big difference between what a client plans to do and what they actually do, and their awareness of what they actually do. And we don't make it easy for them either. Account statements are filled with interest payments and dividend, like how do you really cull it down to, we had an agreement that you were either going to withdraw or you were going to save X. And the other thing is tying that short-term action to some long-term behavior or impact. So the idea that small decisions and small changes can have impact if you do them early enough and often enough. We don't do a really great job of getting in front of that. So if I come back and look at my plan and I've overspent in the first year of retirement let's say by 20%, my client's still gonna say I'm okay because I've got enough assets to last the remainder of my life. If you reran that and said to a client, hey, what happens if you did that every year for the next 5 years? And extrapolated some of that behavior, so we can pull that back in, arguably, reining in the cash flow lever is gonna have a bigger impact than a lot of what we're talking about, yeah.
So I think we're over time. It's a great topic. We could go on and on, but thank you, panelists.
Nice job.